I'm Nigel Morris-Cotterill, and this is Financial Crime Basics from FinCrimeTV. In this episode, what is cash, etc. transaction reporting? This is a long presentation, and we're going to look at why cash transaction reporting developed, some arguments against it. We will look at its complications, anti-avoidance measures, and the solution to problems those measures cause. At its simplest, cash transaction reporting is the making of a report to the Financial Intelligence Unit when a deposit into or a withdrawal from an account is made in cash and that cash exceeds an amount specified in law. If you've listened to anything on FinCrimeTV, you will have already realised that nothing that looks simple is ever simple, and that every acronym and buzzword is at least misleading and often completely wrong. In this case, cash transaction reporting is misleading. It does indeed relate to cash, but it relates to so much more. And while in its narrowest interpretation it relates to deposits and transactions, there is a wider interpretation that includes much more than cash. Finally, while it applies to bank etc. accounts, it also applies to a wide range of businesses both within and outside the financial sector. One of the biggest criticisms of cash transaction reporting is that it creates a vast amount of noisy data which has to be filtered, much of which has to be, for all practical purposes, discarded. That requires immense computing power and human analysis, and that means massive cost to a country's budget. So how do we get here? Well, this programme was becoming far too long, so I've put part of this explanation into an article at World Money Laundering Report, and the link is in the notes below. The article is called How Boston Benefited from a Massive Drugs Trade and Post-Colonial Commerce. In the 1960s, the USA, which had already proved that prohibition doesn't work when the population wants a product, set about developing a system to identify who was dealing in large amounts of cash. It's a surprise to many that the woefully misnamed Bank Secrecy Act was passed as long ago as 1970. The principal purpose of the Bank Secrecy Act was to do more than authorise banks to break the confidential nature of their relationships with customers. In fact, it actively requires them to do so. It was a simple and brutal measure. Banks, primarily, were required to file with the US Treasury details of any deposit or withdrawal of cash, at least any deposit exceeding an amount. The required details were basic: the amount of money, the account number and the location, and the name of the account holder. Actually, the Bank Secrecy Act is a buzzword, and yes, it's misleading. The legislation is actually called the Financial Record Keeping and Reporting of Currency and Foreign Transactions Act of 1970. And you can find it at 31 US Code, sections 53(11) and afterwards. And there were also parts of it in Title 12 of the US Code. When you read about that act today, it is barely recognisable compared to the original. At that time, there was no Financial Intelligence Unit. FinCEN would not be created for another 2 decades. There was no suspicious transaction reporting. In fact, almost 3 decades later, the USA would strenuously resist the FATF's requirement that countries should impose suspicious transaction reporting, saying that cash transaction reporting met all its needs. Decades later, FinCEN said that it was not going to require similar supervision for, quote, hedge funds as it does for other industries, and it cancelled its draft requirements, saying we already have eyes on the money through the banks. Several weeks later, literally only several weeks later, the Bernie Madoff scandal erupted. Clearly, nobody had eyes on the money. There was a requirement to create and retain records so as to be able to reconstruct transactions if required by an authorised investigation agency. So the Bank Secrecy Act was a federal act. That annoyed some states, and there was uproar on both civil rights and constitutional grounds. But by 1983, William French Smith, the then US Attorney General, felt able to endorse cash transaction reporting in the strongest terms. He said, "The Bank Secrecy Act contained in Titles 31 and 12 of the US Code is becoming an effective tool in the fight against illegal narcotics trafficking. Although the Act has not been well understood or used since its passage in 1970, small groups of investigators and prosecutors around the country have come to realize that currency transaction reporting statutes can be used effectively to attack criminals and illegal enterprises by focusing on the huge profits and benefits they reap. The Bank Secrecy Act is specifically designed to aid in this attack by creating a paper trail to trace drug and other proceeds back to their illegal source. Long-term financial investigations aided by IRS computers and sophisticated analyses of currency transactions are resulting in the indictment of high-level drug suspects. Moreover, as the financial industry begins to fully comply with the requirements of the Bank Secrecy Act, large-scale drug dealers will have a more difficult time moving illegal funds, and consequently they will increase their chances of being apprehended." Well, that approach led to a fixation by the USA on the reporting of cash transactions and the analysis of resulting data. Yet there is a social and political consideration. Cash transaction reporting is utterly indiscriminate. In multicultural societies, those from Asia, including the Vietnamese and Koreans that migrated to the USA after their wars, rated disproportionately in the cash transaction dragnet. In 1999, I raised this question with the then director of FinCEN, and he was visibly surprised by the possibility. He said he didn't think that could be so. Later, he announced a review into the effectiveness of cash transaction reporting, and he made specific mention of the potential for bias. Shortly after that, a new director was appointed, and so far as I've been able to discover, that review was never completed, or at least no report of it was ever made public. No one in a position of similar seniority has since asked for evidence of the value of cash transaction reporting. The USA set the cash transaction reporting limit as $10,000 in 1970, and it's resisted all calls for that amount to be linked to inflation. As of mid-2023, the equivalent amount would be about $70,000. Countries around the world have imposed cash transaction reporting, starting with amounts similar to the USA's $10,000. But currency exchange rates have resulted in significant divergence in the equivalent current value. Around the world, countries have adopted or rejected cash transaction reporting for banks. In addition to cash, transaction reports are required for cash equivalents, such as traveller's checks, bearer bonds, redeemable bonds, and others. Exactly what is subject to reporting varies from country to country. Most countries have currency reporting requirements at borders. The amount is usually, again, $10,000 or the equivalent in any other currency. Cash couriers and personal travellers must declare such sums to customs. Failure to declare is a criminal offence, and the unreported amount will often be confiscated. Also, customs officers will usually ask for an explanation as to why such sums are being carried rather than transferred through banks and so on. If they're not satisfied, the monies may be held until a satisfactory explanation is given, or if none, again, the monies may be confiscated. While the transaction limit for banks, etc. in the USA is $10,000, there is a related cash transaction rule that does not require a report to be made. Financial institutions must identify and record the identity of cash purchasers, or those who cash out, money orders, bankers' drafts, cashier's checks or manager's checks, travellers' checks, and so on, of $3,000 or more. This record must be maintained for inspection, but no report is required unless there is also a reason to report suspicious activity. Bureau de charge and remittance agents, also known as money transmitters, are subject to requirements that vary from jurisdiction to jurisdiction. All are required to be registered and in general must identify and record information relating to all customers above a very small threshold. This also relates to fintech companies, some of whom are permitted to avoid identification where the amounts of money are very small. Again, this varies by jurisdiction. I should mention that many countries require the recording and reporting of international funds transfers, some for quite small amounts. Some countries require advance notification of the intention to transfer funds, and will release the funds for transfer only with the authorization of the central bank or other authority, based upon whether it is accepted that the transfer is justified. So we've dealt with cash, redeemable things like travellers' cheques and bonds. What laws have failed to keep pace with is the physical transfer of money on, for example, prepaid cards. This was marked as a concern in the mid-1990s when I drew attention to the risks of a then new product called Mondex, which was in essence cash on a card. The card issuer could authorise such amounts and such currencies as required on a case-by-case basis. Mondex itself set a limit of 5 currencies, each with a maximum of £5,000, but it later changed that to a much lower amount. Today, the hot topic would be self-hosted crypto wallets. These are indistinguishable from an ordinary USB stick and can carry what is, for all intents and purposes, unlimited amounts that, for the tech-savvy, can be transferred without touching a regulated exchange. Even in jurisdictions where there is no national cash transaction reporting, financial institutions will almost operate an internal cash reporting system. This is because the use of cash may be a useful indicator for suspicious activity where it is out of the usual pattern of behaviour for a customer. Cash transaction reporting systems acknowledge that if it is required that transactions of X or more must be reported, then criminals know that, and so they will simply make multiple transactions falling below the reportable limit. In the USA, which led the cash transaction reporting approach, it was soon learned that criminal gangs recruited armies of people to make deposits. Someone decided to call them Smurfs, which was funny at first, because of a then current children's TV programme. Then it became old hat, and some people still use it, and still they think they're being trendy when they say it. The formal term, which has the remarkably uncommon trait of saying what it means, is structuring. It's actually from an old term from law, when a court would order a payment of damages to be made over time in what is called a structured settlement. In relation to money laundering, it means to structure large deposits by depositing 2 or more smaller amounts, each falling below the reporting threshold. It is an essential system, but the way that it has been implemented is frankly moronic. Here's why. In order to identify connected transactions, it is necessary to identify the persons making the deposits or withdrawals, but as explained above, identification is only required when each transaction reaches a specific threshold. Structured transactions, by definition, don't reach that threshold. This means that the transactions can only be identified with reference to an existing account. So the person performing the transaction remains outside the scope of the system. It also means that where there are multiple accounts, structuring can take place by many people into those multiple accounts, and then those accounts at a later date can have the funds transferred to a central collection account. And that all misses the transaction reporting system. Worse still, there is a time limit. Financial institutions are required to identify connected transactions taking place within, depending on the jurisdiction, as little as 1 working day. So deposits made today will not be connected to deposits made tomorrow, even if they total more than $10,000, under the scheme for reporting to the FIU. Doesn't mean they won't be connected for internal purposes and therefore a cause for suspicion, but they will not have to be reported under cash transaction reporting to the FIU. There is one saving grace. That time limit does not apply where a regulated business identifies what it suspects are connected transactions, and because structuring transactions is an offence, a suspicious activity report must be made if the institution does make that connection. That appears to be an accidental result that turns a very badly thought out system into a potentially valuable tool, and in doing so underlines why suspicious activity reporting is a far more effective tool than cash transaction reporting. See, it all sounded so simple when we said cash transaction reporting, but it turned out it wasn't simple at all. Thank you for watching. Don't forget to follow, like and share, and of course to keep watching FinCrimeTV.